Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. Here at ADISA, we're committed to providing thought leadership and insights all around alternative investments. My name is Greg Mausz. I'm your host today, and I'm joined by Sandy Geyelin. He is the SVP of Global Wealth at Athene. Sandy, thank you for coming in.
Thank you for having me.
So today we're going to be talking about private placement insurance, private placement variable annuities. This has traditionally been kind of an ultra high net worth type of investment, but it's kind of coming downstream for the accredited investor, which is fantastic. Can you start off by kind of describing what are private placement insurance and private placement variable annuities?
There are two products, as you mentioned, private placement variable annuity, known as PPVA, and private placement life insurance, known as PPLI. Both of those structures are designed to really focus on the beneficial tax attributes that are afforded all insurance and annuity contracts, while minimizing some of the other features that are typically associated with the retail or traditional annuities and life insurance, things such as guarantees and other, both on income as well as death benefits. Private placement variable annuity really provides the tax deferral of the underlying investment gains. That includes federal, state, local, and ACA income taxes that would otherwise be paid by the client if they were to invest in the investments directly. There are no guarantees associated with the PPVA. There's no underwriting. There's generally very little, if any, upfront expense, and there are no surrender charges. So it is really viewed a bit like a tax-deferred investment account. There are no limitations under the tax code as to how much after-tax dollars or non-qualified money can be contributed into a PPVA, typically speaking. Some products may have maximum, but generally speaking, people are able to invest an unlimited amount of funds into the PPVA and benefit from the deferral. The consideration for a PPVA is that all of the gains of the underlying investment are converted to ordinary income when they decide to surrender or take withdrawals from that PPVA. And as with other annuities, the withdrawals come out first, and the client can then redeem their basis second, which would come back tax-free. So it works similar to an IRA, which it's often compared to with after-tax dollars. Any money taken out before age 59 and a half would be subject to a 10% federal tax penalty. Unlike an IRA, there are no required minimum distributions at age 70 or 72. Mm-hmm. And so typically people can continue to defer the underlying investment gains until age 95 or potentially later. Again, it varies depending on the type of PPVA product. But that's at a high level what a private placement variable annuity provides: income tax deferral.
Right.
Private placement life insurance is a variable universal life chassis or policy. It provides the same income tax deferral of the underlying investments. It is generally designed to maximize the cash value accumulation of the life insurance policy by minimizing the amount of insurance or death benefit that policy provides, still making sure it's in accordance with the different sections of the tax code that define what life insurance is. As is the case with most life insurance, there is the ability, if the policy is structured properly as a non-MEC, for the client to...
As a non-MEC?
As a non-MEC, yeah. Non-modified endowment contract is just one of the definitions of life insurance under Section 7702 of the code. Typically, a client would fund their investment dollars in over a period of time. And structuring that policy that way would afford them the ability to take withdrawals up to their basis tax-free, as well as take what are known as policy loans against some of the accumulated cash value, also tax-free during their lifetime. So there are some additional effectively tax-free growth of the underlying investments. And there's a death benefit associated with the PPLI.
How does that work?
So again, it's generally structured to provide the minimum amount of death benefit that is required early on in the policy's life. And there's the option that clients would typically choose to elect to reduce the death benefit later on in the policy's life, to reduce the insurance or the friction expense associated with the accumulation of the investment account. And then upon death of the insured, the beneficiaries would receive the death benefit, which is going to be either equal to or greater than the investment account on a tax-free basis. So like all life insurance, the death benefit is considered tax-free. There are some limitations to PPLI. The client does need to go through a medical underwriting. It is life insurance like all other insurance products.
How strict is that?
It's as strict as other insurance products. So it's the same. It's the same process. It is life insurance, and typically there are higher death benefit amounts because the amount of investment premium going in is considerably larger. So the client will have to undergo rather thorough life insurance underwriting, but nothing too out of the ordinary. And then there are other expenses. You are buying insurance, so there are going to be the expenses associated with providing that death benefit if the insured were to pass away before they were expected to. But you get the benefit of the growth. Again, so the limitations are on the timing to make an economic policy, how frequently you contribute the money, and there are limitations as to how much money one can contribute into a PPLI policy, and that's generally dictated by how much death benefit they're able to secure, and that will be a result of the underwriting and other factors. So high level PPVA is a tax deferred annuity, investment only variable annuity that provides tax deferral for relatively lower cost compared to life insurance, which provides the tax-free growth of the investment, but comes with some additional steps and expenses.
Thank you for walking us through that, laying that foundation. Sure. Very helpful. But this is a little complex. Yeah. So let's go into some examples. Can you discuss some case scenarios that an investor may want to engage in these?
Yeah, certainly. So for a PPVA, one of the most common applications is to the extent a client is looking at an investment, and particularly these are used to access alternative investments, private credit, hedge funds, things of that like, where for a high net worth individual, they're rather tax onerous. So if an investment that a client would like to make is going to trigger a lot of ordinary income to begin with, if they can hold that investment inside of a PPVA or choose that investment strategy inside of a PPVA, they benefit from the deferral of that investment return, and that will provide benefit as the longer they are able to defer that investment growth. So simply the first case is simply as an asset location vehicle for tax inefficient investments. And often a lot that first investment into alternative may come from an existing retail annuity. So there's something known as a 1035 exchange in the tax code, right? That allows clients to transfer on a tax-free basis existing annuities. So we do see a number of instances where a client had purchased an annuity that provided that guaranteed income that they were looking for at one point in their life. Years pass and they find themselves in a different financial situation where that guarantee income isn't as important to them, and they want to diversify their portfolio into alternative investments. They can use those assets in that retail annuity, 1035 into a PPVA to get that exposure to the more that private market investment. And with the PPVA, since there are no surrender charges, if for some reason they wanted that guaranteed income, they can always 1035 back to a retail annuity. For both PPVA and PPLI, we do see clients that have set up grantor irrevocable trusts, which are have great estate tax benefits. However, in those structures, the grantor pays the income tax liability generated by the underlying trust assets, and as those trust assets grow, that income could become and that income tax liability could become a bigger share of the grantor's financial resources. So having that trust invest through a PPVA or a PPLI can shut off the income tax liability to the grantor. With a PPVA, they would certainly the trust would pay tax or the grantor would pay tax. Eventually with the PPLI, they would if they took withdrawals, but if they held the PPLI until the passing of the insured, then again it eliminates the tax that the grantor would otherwise have to pay on those trust assets.
So these are great structures, powerful structures. And you're walking through all the estate planning and tax strategy here. But I want to talk a minute about the underlying investments in here. Yep. The insurance dedicated funds and the different types of alts you can put in these structures. Can you touch on that?
Certainly. You'll often heard the term an insurance dedicated fund. when you're speaking about PPVA and PPLI. An insurance dedicated fund is a private investment fund similar to any other hedge fund or private credit or private equity fund that you would invest in, but it is available exclusively through insurance companies' separate account products like a PPVA and PPLI. They are analogous to a variable insurance trust or VIT, which are the investment options you would find inside of a registered or retail variable annuity. So VITs are like mutual funds in the taxable world, and the insurance dedicated fund is like a hedge fund in the private market alternative world. And so
you can't just stick any investment fund in this wrapper.
Correct. No. So there's unless the underlying investment is an insurance dedicated fund, the client, the policy owner, cannot choose the investment. But a lot of insurance companies have a menu of insurance dedicated funds across a range of alternative private market investment strategies and from various firms that the client is then free to choose how to allocate their PPVA or PPLI investment dollars.
Sandy, really appreciate you walking us through this.
Yeah, certainly.
For more educational content like this, please visit adisa.org and stay tuned for another upcoming episode.